Hey guys, welcome to another video. In this video today, we will be discussing the 3 things your business needs in order to not only grow sustainably and profitably, but also what 3 boxes you need to tick to get investors to want to give you money in exchange for shares in your company. Okay, so if you are looking to raise capital to grow quicker, these are the 3 boxes you need to tick. And at the same time, if you want to build a sustainable, profitable business, these boxes apply, because no investor is going to invest if you don't build a sustainable and profitable business. Okay, and I'm sharing this today because we're actually going through a process where a big conglomerate would like to invest in the existing V8 capital business that we've invested in and we've grown over the last 2 years, and all the information is top secret for now, but there's a lot of lessons along the way that I think you might find very valuable. So before we dive in, if you like marketing and business content, then I believe this is the channel for you. So it would mean the world to me if you like and subscribe, and maybe even hit the notification bell to be notified about future videos like this. So without any further ado, let's dive into today's video. Okay, so let's say you started a business 3 to 6 months ago, and you're actually at the point where you're looking to bring investors on board in order to take this project further with you to build something more sustainable and profitable for everybody. Now, here's the thing. A lot of investors are most likely not going to invest in any business that's doing less than 300 to 400K a month in revenue. And the reason I say that is because if you're beneath that level, then the business is still seen as an idea. You know, it's not really a business yet. Like, you might be doing 4 million or 5 million a year in revenue, but that's not really a massive business, because the size of the business is actually dependent on the amount of profit you make, not the amount of revenue you make. Okay, so the average business has let's say a 12 to 15% PBT, or maybe 20% PBT, profit before tax. So let's say you have a business that's doing 500K a month. That's roughly 6 million a year. It sounds like a lot, but remember, the average business has a 20% PBT, well, actually more like 15, but let's say 20%. So in essence, 20% of that is 1.2 million per year in profit. Now, that now is a nice little business that someone can invest in order to take much further. Okay, if you under this, let's say you make 300K a month, then in theory you're only making 40 to 60K a month in profit. That's not a ton of money if you're really trying to build a successful business. After hiring, you still need to probably hire people in order to expand, and more stock and cash flow, and there's not going to be a lot of money left that you can spend on yourself. And an investor, when they look at a business, they're not investing in ideas, they're investing in future cash flow and predictable returns. Okay? So what do investors want? Investors want predictable cash flow and predictable returns. So, which is profit back on their investment. Okay? So cash is going to come in, and over time they're going to pay themselves back, and then they're going to get returns after that. So that's what they want. They want predictable cash flow, and they want predictable returns, aka profit after the investment. So that is what that's where your mind should be if you're trying to build a business. It's not about the idea, it's about how is this going to translate into a revenue stream that is predictable, that can have free flowing cash flow after expenses, aka profit, and how can we scale that in order to create more profit for everybody involved. So that's what investors really look for. And in a nutshell, you can almost see it as they're looking to build an asset, because that's really what that all is. If you have something that gives you predictable revenue, predictable cash flow, predictable profits, that's a huge asset, as long as it keeps growing, obviously. So in essence, investors want assets. They don't want ideas. They don't want small businesses that are, have glass ceilings. And that's what we're going to be talking a little bit about today. Cool. So what is the first thing you need to think about when you want to build an asset? There's a quote that I put up on social media a while back, and it said, most business owners think they're building assets, but they're actually building prisons. And that's such a powerful quote, in my opinion, purely because you slave away for most of your life building something that you think is valuable, but then the day comes when you want to sell it, and then the people that you want to sell it to goes, but we can't buy this because it's not the asset that you think it is. And often the business owner on the other side would get emotional, and because they've put their blood, sweat and tears into it for their whole life, they get so emotional and they get so frustrated with the actual acquisition process that they often either don't sell and still stay a slave to that business, or they get a very raw deal. So they were expecting 10 or 20 million and then they only get 2 or 3, or maybe sometimes less depending on the business and the industry and whatnot. So in theory, often I think business owners don't really understand that they're actually building prisons because they don't tick these 3 boxes. And when you can focus on these 3 boxes mainly, I believe you'll build something that's really valuable, aka an asset. So the first thing is scalability. So this is essentially what investors want to see. They want to know, if we invest, can we grow it? And ideally, time plus effort is also accounted for. So think about it like this. It's like, how quickly can we grow? You want to grow as quickly as possible. You want to grow quickly as possible. You want to have as less effort as possible. And you want to have as much profit as possible. So growth should be quick, effort should be little, profit should be a lot. That is the ideal opportunity, right? For any business. I mean, you'd be stupid if you had an opportunity where someone said, we can grow this business to triple its size in the next 12 months. All you have to do is just give us cash and do nothing else. And I promise you, we're going to be making, or I almost guarantee that we can be making this amount of profits. You're going to be like, done, let's go, right? So that's really what investors want when it comes to scalability. And another way you can look at scalability is, can revenue increase a lot faster than the expenses of the business? Because if you can increase revenue quickly and expenses remain the same or grow in a very slow ratio in accordance to the amount of revenue, then essentially what's left? Profit. Okay? So if revenue does this, but expenses only does this, the difference here is what we call profit. And that's what everybody wants, because that is what pays the shareholders their dividends. That is what directors get as bonuses. That is what pays for more staff, for more stock, for marketing, and all these things. Without this, you are dead in the water, because every month will become a fight. Every month, will be really just a painful experience, because you're hoping to make some profit. You're putting in all this effort, but you're not making profit. You can't pay yourself and the people around you fairly, etc. So this is why scalability actually boils down to revenue growing a lot quicker than the actual expenses in itself, which then equates to you making more profit. So let's put it this way. If you haven't started a business yet and you have an idea, the question is, does that idea tick this box? Is it an idea that is scalable? All right, that's the first thing I started looking at as well. And I did that just because of my own experience. Nobody actually told me that, but when someone told me that, I was like, well, that makes so much sense. I've looked at it in my own little bubble and my own little limited lens and point of view. But when I actually understood what it's all about, I was like, well, that makes so much sense. That's really what everybody wants, is profit. And the only way to make as much profit as possible is to ensure that your revenue increase so much faster than the actual expenses, and that the expenses of running the business is always at a minimum and the revenue is always at a maximum. That's another way to look at it. Cool. So that comes down, that's what scalability is all about. So if you have that idea, the question is, does it tick this box? If you have a business, so let's say you've gone from idea to actually executing and you have a business, the question now is, does the business objectively back up that it's scalable? All right, let's move on to point number 2. So point number 2, I would like you to guess what it is. Just think about it for a second. because I think a lot of people don't think about this point specifically. So like scalability is a no-brainer, right? I feel like if I had to ask 80% of small business owners, what do you think people want to see? They're going to say they want to see that my company can grow really quickly and profitably. Kind of like a no-brainer, right? But now the second point is a bit more interesting. This is what we call defensibility. Defensibility. And defensibility is crucial. The reason it's crucial is because you ideally want a business that grows as quickly as possible without expenses growing at the same rate, which means you're going to make more profit. But then at the same time, you want to ensure that that remains the actual outcome for as long as possible. And the only reason it will sustain is because you don't have hundreds of competitors trying to copy you. And we have seen this so many times. We've worked with over 500 companies now in the last few years. We have seen companies come and go, and the ones who actually closed their doors are the ones who didn't have a strong defense or a strong armor against copycats. Warren Buffett calls it the moat around your business. Okay? So is the business scalable, but at the same time, is it defensible? Can you protect the IP for as long as possible? Because if you can sustain that scalability for a long period of time. If your business is not defensible, meaning you don't have intellectual IP that is difficult to copy, which means everybody can copy you, then more competitors are going to come into your market overnight. And what that then means is you're going to have to fight a lot harder to get customers, which means that your expenses are going to go up because marketing costs will go up and the cost of acquisition will go up. And as the marketing goes up, revenue will decline purely because there's more choice in the market. So in theory, the less defensible your business is, the shorter the lifespan of that business. And we have seen people come in selling one product. We've had a few companies come to us with one or two products only. And those business owners either didn't innovate quick enough, or they innovated by stacking the wrong products into the business. They increased the variety of product by buying the wrong products that people actually don't want, along with the main product that they actually have. If that makes sense. So what happens is, not only are they fighting competitors, but they've also made the wrong decision of what synergistic products they're actually bringing in to complement the brand. And now they're fighting two battles. They're spending a ton of money on product that people, on marketing, trying to convince people to buy something they actually don't want, which is the products that they've stacked into the business to increase variety. The other thing is, they actually fighting competitors for the main product that's actually making them the most revenue. So you're fighting two battles. You're fighting the battle of, I have to protect my market share, and because everybody's trying to copy me for this one or two products that I have. And at the same time, well, now I'm trying to be innovative by creating new products for this range that we have, or this brand that we have, but those are not really products that people want, and you made a bad decision on making those products, or bringing in those products, or manufacturing whatever. So the bottom line is really that if your business is not defensible, the actual sustainability of the scale ability and the profit will just be less. So you have to have the following things in the business, in my opinion. Some form of IP, which is intellectual property. Something that differentiates you from other competitors. And if other competitors try and copy this, it needs to be very difficult for them to do. It has to take, for example, hypothetically, at least 2 to 4 years in order to get that exact product right. Because that gives you this amount of time to innovate on the next product or the range as a whole. If the product IP is terrible, then and copying you is super easy to do, then your lifespan of the business only is up to 3 to 6 months before competitors will come in and start eating your market share. So you've got 3 to 6 months to maximize profit before people start eating your lunch. So that essentially is IP. The other thing is just brand. The stronger the brand, the longer people will stay with you. So a customer would buy from you, they would have a really great experience, they would see the brand online, they would resonate with it emotionally, and because they bought from you and had a good experience, you're strengthening that level of trust. So brand, in a way, equals trust. So you want as much trust as possible in the market that you're in and the industry that you're in. And the bigger this is, the higher the probability of your business being defensible, if that makes sense. So if you don't have IP, you need strong brand. The problem with brand is it costs a lot of money. So brand in itself, costs a lot of money because you have to spend money on marketing in order to get people to see and resonate and actually become customers. And the other thing about brand is it takes time. Brand doesn't happen overnight. Brand takes a good, I'd say 12 to 36 months on average in order to actually be a recognizable brand. This is obviously dependent on how much money you spend on marketing, because there's people who have been in business for 3 years and people still don't know who they are, and it's purely because they haven't spent any money on marketing in order to tell people who they are. And then there are brands, like two of the brands that we've actually built over the last 2 years. Both of them are probably the best in their space, but it's because we scaled aggressively, and we're spending millions a month on marketing. So in theory, the time it takes to build the brand is related to how well your customer experience is, but indirectly, it all ties back to how much money you're actually spending on marketing. So building brand takes time and costs money. IP in itself could be expensive. Sometimes it's not that expensive. It varies. But ideally you want IP, ideally you want brand, and then slowly but surely you are starting to create a bit of a moat around your business. Cool, so we've got scalability, defensibility. Those are the two things that is crucial to building an asset for yourself and something other people would want to invest in. Here's the last thing. And I mean, you've guessed this. If you've watched any of my videos, you know that I hammer this all the time, and that is margins. So you need healthy margins. So I talk about margins all the time. So I didn't start the video with margins because if you did watch it, you'll be like, well, we've been down this road again. So I said scalability, I said defensibility, and I do think those two are really crucial. But none of that will actually really materialize if you didn't have healthy margins, because margin in itself is really what allows you to grow the business. If you think about it. So margin, let's call it you've got different types of margin. So you've got GP, which is your gross profit margin. Then you've got operating profit margin, and then you've got mainly net profit margin. So net is what's left after everything. So that's kind of like the bottom line. And operating expenses is what's left after COGS, which is cost of goods, plus any other expenses. And then GP is just the difference between the cost and the retail price. So that's what we call, it's basically your COGS percentage, cost of goods. So I did that a little bit in reverse, but your GP refers to the cost of the product, what you paid in order to get it, and the money that you made back after selling it to the public, that difference. So if your cost is $50, and if we had a chart, it would be there, and your retail price is $200, then you have what, in theory, 150 Rand left, and that's basically your cost of goods, your gross profit margin. So this is the $50, and that is the difference. This here is essentially the remaining profit margin. And this, my friends, is what you use to hire people. This is what you use to pay shipping. That's what you use to pay transaction fees. That's what you use to pay for rent and bonuses and other marketing, which is the most important one, which I kind of left out. So in theory, it's going to be very hard to do all of this if you only had this much left. So this is where you were, this is where you are. And there's no way you're going to cover all of that with that much, even though it's all theoretical and hypothetical and based on a schematic that's not at all closely relating to anything in real life. But the point is, you get what I'm trying to say. Margin is crucial, because margin is what allows you to actually grow the business. Margin is what allows you to pay for growth and still have money left, which is profit that you can share with everybody else. Okay. So margins are crucial. The question now becomes, what is a good profit margin? So in my case, if it comes to GP, you want 30% minimum. If you're going to sell online yourself, you need 50%. In the ideal world, 60% or more. Now this varies for different industries, because someone is going to say, listen, I'm in tech, my margin is less. Yeah, so you make less on a TV, your margin might be 5%, if you're lucky a little bit more, but you're selling a TV for 20 grand. Okay, so you put a little bit more money into your pocket, but the percentage is very little. So that's also, some nuances that we need to understand. But all industries are different. But I'd say if you can be around here and around here, you will have a really great business. And investors would love to see this. If you're down at 30%, it means that you'll have left a little bit less left to grow the business with, which means expenses and revenue are going to be very closely related to growing the business. But if you have these margins, there's a good chance that you can grow a lot faster in revenue without increasing the expenses too much. So that is GP. Operating expenses, I'd say aim for 25 and at a high end and 15% at a low end operating margin. So this is basically then what's left after you've paid the cost of the product and the cost of everything else that you need to run the business with. And then net profit, which is number 3, that ideally for most businesses is between 8 and 15%. If you have anything more than that, that's great. So investors would love to see 20 to 30%. That's going to make them smile all day. That's going to make their faces look like this. This is okay, but it's not going to get them overly excited. So there you guys have it. I hope I made sense. I was rambling, felt like I was rambling a bit. But the bottom line is, if you're going to be building an asset, you need to ensure that you're creating something that can grow sustainably, predictably, and as quickly as possible. If it's not going to grow as quickly as possible, that's fine, but at least it needs to be predictable and sustainable. And the way you do that is by having a strong defense around you. So you have to have a sense of defensibility. You have to have strong brand. You have to have strong IP. And then the last is just margins. So scalability, defensibility, and margins. If you have those 3 things and they are really good and it's sexy, there's a good chance you're going to get people salivating to be a part of your business. And there's a good chance you can build something really healthy for you and the people around you. All right, that's all for this video. Much love to you guys. All the best. Cheers.